following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. Well, we're going to have Shane Smolian on at the break at 9:30. He'll give us about 3 hours and about 20 minutes of what's really going on. I think you're going to enjoy that. We also have Norm Winsky on tomorrow. And then on Friday, we will have Rich Anderson on to discuss the grains. And we need to talk about the grains just a little bit. Today, I'm going to do a little bit of grains and then quickly go over gold, treasury bonds, and the stock market before we get Shane coming in, because he has some really interesting things from his 26-page newsletter that he put out over the holiday. The first chart that we're looking here is the wheat chart. This is September wheat. We were looking at that on Friday, and again yesterday we got down to, we were looking at 418 a bushel. It got there, rallied 15 cents a bushel. It's since backed off about 4 cents a bushel, still holding that level. That's a hammer candle down there, folks. That's usually a pretty good sign. That's the opposite of a shooting star. And so if you happen to do that trade, I would put your stop at break even and let it go, because wheat really responds well to the lunar cycle. And we did have, you know, the new moon yesterday, and we'll see how that holds out. Now, I also wanted to just talk a little bit about the soybeans here. We're looking at the same pattern in corn as we're looking at wheat, by the way, but wheat has already made it. Corn's still a few cents away. But I wanted to show the chart here for your November beans, because this is an interesting pattern for just 1 second here, if I can get it to work. There we go. You'll notice here, this is an hourly chart going back over the last 5 weeks. As you can see, the ABCD pattern that occurred right at the 78% retrace, well, it's actually right at the 61% retracement up at that 1157 level. And then as you can see, the big gap down that we had over the weekend. But see, that market was really telling you that it was probably getting ready to correct, because we had topped several days before the weekend up at the 1160 area, and then we sold all the way down and closed at around 1137 on Friday. And then of course we had the big gap down where we took out the lows from mid-June. So that's an interesting thing. But let's not lose sight of this pattern, folks. Let me show you why. If you take a look at the long-term daily, and this is one of the things you do when you're looking at these things, you want to keep a perspective of what's going on. You'll notice that when we bottomed down here in March, you'll notice that 135 pattern where we had the higher bottoms. That was the pattern from Roy and Bill Longstreet. Now look what's happening. You see we have that ABCD structure coming in down about another 25 cents from where we closed. That's really our first major ABCD correction in the whole move. So you've got to pay attention to that, in my opinion, at this 1035 area in November beans. So, but beans move around a lot. They'll move 30, 40 cents, as we've seen. They moved over 40 cents yesterday, so they can move very, very quickly. So we want to watch that. There's a possibility that the whole thing is over. And if you notice that the high that we made, back in June, early June, was a 1.618 expansion within about 4 cents of the exact 1.618 level. So it's not going to be easy here, but you have to pay attention to that, because we're a long way from bringing this crop in. This crop doesn't come in until October, so it's got a long way to go, and it does. It's holding up. We're not going to stop eating grains. There's no question about that, especially with corn and also with wheat. But those are a couple of the patterns, that we're watching, very, very closely. Now, since we're on the subject of 1.618, I wanted to bring out Another one here. If you'll give me a second, we will pull up the chart for, there we go. We want to put up the chart for gold because we're looking at the same type of number, 1.618 expansion. Now this is the one that happened right after the Brexit. You see, we had the holiday on Sunday, Monday. You notice we closed at 1344 on Friday, and then last night we got up to the 1376 level, which was right into that area of the 1.618 expansion. And that's why this is looking so very interesting in this area right here. If you remember, we've had all these really wild swings in silver, over the past few days. We had the same thing going on yesterday when the silver came down and made a perfect, ABCD structure at 1970. Last night we got up to 2080, which was the 78% retracement in the silver, and that has held so far. We backed off just a little bit and just completed another small ABCD pattern. Now silver has slowed down a bit. It was only moving at about $3,000 or $4,000 last night, as opposed to $23,000 that we had on the over the weekend on that July 3rd and 4th area. So these are the things that we're watching. We've got some really strong 1.618 numbers coming in here in gold, and we've already finished the one in wheat. And you remember, though, when 1.618 numbers fail, and let's look at one of them right here, because this is the British pound, and you'll notice that we had that big, Brexit bar, as you can see. This is a monthly chart, but we did take out that low of the area, and we got all the way down to 127. Now, 127 happens to be the 78% retracement from the low from 1985 when we had the Plaza Accord. Then the pound rallied all the way up to about 250, I believe. And now we're down here at the 78% retracement of that whole moon. The problem is it's extended down way past the 1.618 retracement level, so it's going to be difficult. You'll have to go down to a 30-minute chart to get a safe entry point, would be my suggestion here on this. We've only got a few more minutes here before we have Shane on, who I'm sure you're going to enjoy. But we've got another market, and I know you're not going to believe this one, but we're going to put it up anyway to take a look at it. Let's just do it one at a time. Let's just show you what happened here to the German Bund here over the last couple days. This is the equivalent of our 30-year bond. And as if you'll notice, we made a 61% retracement here into the July 5th. And of course, as all you're aware, we now have $10 trillion in negative interest rates out there in bonds across the globe. 10 trillion, folks. That's 10 times bigger than the the subprime level. So that's it. And we also have even high grade bonds are actually in favor. So we'll see here. Next, we're going to cover what the German Bund has done last night, and we'll take a look at that in just a moment. 877-927-6648.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and we're taking a look at the German bond. This is the equivalent to the 30-year Treasury bond. As you'll notice that last night it made a 78% retracement as we were making a 1.618 expansion in the Treasury bonds that I'll show in just a minute. But also the Treasury notes that we follow has made a higher high by one tick. I mean, that's very, very minor considering Treasury notes are 6 times the volume and open interest as the Treasury bonds themselves. But if we take a look at the Treasury bonds over the last 6 months, you're going to see this 1.618 number again that we like to look at, because that's the number of, the final, the line in the sand, so to speak. If you'll notice, if you look at this chart on the far left, you'll see the red square that I mark at the 1.618 expansion. What you're looking at here is the high from February to the low in May, where we had a double bottom in March and May. And now we've completed that ABCD pattern at the 177 level. The exact 1.618 was 177.03, and the high so far on this has been 177.03. I don't know if that's a coincidence or not, but we're now trading a half a point below that level. So this is a place where we have low risk, I think. And of course, I thought it was low risk the other day, folks. So what do I know? But we'll see what's happening. Let's move on. We've got just a short period of time. I want to do the stock market last because there's one that really is interesting here, folks. And this is the crude oil market. And I'm just going to give you a little bird's eye view of what I'm looking at. If you look at this, this is a 4-hour chart. Yesterday, it had a really nice retracement at the 47.40 level that, I said if it goes much below 40 pips or 40 ticks below that level, it's no good, and that's certainly what's happened. But what you have now is you have a potential, and this is an hourly chart, going back to February, which was our double bottom low at $26 a barrel. We are now completing the exact same percentage retracement that we did during March and April. It's taken a little bit longer time. It's taken a little over 5 weeks to complete this correction. But we are making a triple bottom in here at this 45, 80, 45, 90 level in the crude oil. So pay a close attention to that. There's another reason, and that is that if you look at that 38% retracement from the April low, that also comes in at this 45, 40 level. So this is going to be an area where you want to really take a look at a potential for a longer term trade in oil. This market did not collapse, folks. This is just a normal correction, just like we had during April. You know, there's nothing really panicking about this at all. I know you're hearing people, you know, start talking about $30 oil again. Before it gets to $30, it has to hold this support here at the 45, 40 level. So watch that as a very interesting one to look at for a lot of different reasons. You have several ABCDs here at this 45, 40 level, in addition to the 382 and the fact that we have an equal correction from the March, April correction. So that's just the market repeating itself, you know, over and over again. That's primarily, you know, what you're looking at when you're following, you know, some of these things. Okay, we'll switch over now and we'll look over to the devil himself, and that is the E-mini S&P, and we'll pull this up here and we'll take a look at this for just a second so you folks will get a rough idea of what we're looking at in here. We talked a little bit about it yesterday, but you'll notice that we did make, it's hard to see on this chart because I've compressed it down, being 30 minutes going over the last 5 weeks, but up at that near the top that we made on the 3rd of July, while this was Sunday night trading, you'll notice that we made that little 3-drive pattern up there at the 2104 level. Then we broke down and we did rally yesterday to the 382 retracement at the 2087 level. Now we've since come down about 15 handles from that level, but that sets up an ABCD structure near this 2058, which is the 38% retracement of this whole move. Folks, this is a very orderly correction, in my opinion. This is not what we're seeing. If you look at the left side of the chart, back on the 23rd, when we had Brexit bring the announcement out, that was not that's an outlier event. You know, that thing dropped from 2120 all the way down, you know, 120 handles, you know, in a matter of a few hours. We're not seeing that here. This is a very normal correction. So my suggestion is, if you want to be long, wait for this 2060 level. We're still quite a ways away. We're about more than 12 points away, but in these markets, they seem to get to them pretty easily. So watch that. That's a 382 retracement of the whole move, and this has certainly been a bullish market. I mean, you cannot, deny that. But watch this 2060 area, 2058 here in the market. Below that, then we're looking at something a great deal worse. Now, if you look at Asia, the Asian markets have reacted a lot more to Brexit than anybody else. And then also the German market, the DAX, has also reacted more to the German to what's happening to Brexit than anything else. So those are the main ones to look at. If I had to categorize the ones that I think are the most important today, I think the 1.618 expansion in the Treasury bonds at 177 and change is extremely important. The gold high that we've made so far at 1376 is also ranks up there as something very, very important. We've come down about $7 off of that high in the gold, and we'll see if we get silver below the 1970 level. That's going to be another indication that market might have topped, because silver did not make a new high when the gold was moving higher, because all it did was make a 61% retracement of the whole $23,000 move that we had over the last few days. But silver was relatively quiet Now, bonds are now down almost a full point from their 1.618 expansion. That may or may not mean anything, but we still want to pay attention to it. I did want to show you the notes, because this is an interesting chart also, because the notes, if you'll take a look at this, we only matched that high that we made post-Brexit. In fact, we took it out by 1 tick in Treasury notes, and this is the largest of all the commodity volume things that we trade. I mean, this is a huge market, so for it to take it out by only 1 tick, I think is important, especially when you realize that the Treasury bonds are making a 1.618 expansion of that move. So there is some selling coming in here. There maybe have some rational people out there that realize that buying bonds with a negative interest rate, it maybe not be the thing to do. I wish I could do it. This would be a good deal to have working in your favor if you could get negative interest rates. See that. Have Shane Smulyan on at the break, 877-927-6648.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's nadex.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we've got Shane Smulyan on from wolftrader.net. Shane, are you there?
Hi, Larry. I'm here.
Good. Listen, we've got a lot to cover thanks to you, so why don't you fire away? We're looking at that Federal Reserve outright purchases chart, and then we'll move on as you tell me to switch charts, okay?
Sure. Okay, so we should be on chart A now. So the first thing that I'd like to talk about here is these outright purchases of the Federal Reserve, because technically we're not in a quantitative easing period. However, the Fed is still purchasing at a rate almost the same as a quantitative easing period. So if you take a look over on the left, the 2008 and then the 2009 is really when they started purchasing these assets. And you can see the green line is the total purchases. So if you just follow the green line, you can see. Now, most of these purchases were Treasury purchases during quantitative easing. But in 2014, on the right side in 2015, you can see that the purchases began to move more towards agency purchases, which is mortgage-backed securities. So the Federal Reserve is still purchasing. They're still purchasing upwards of $300 billion a year in mortgage-backed securities. So two things to take away from this. Number one, we're still in a quantitative easing type of a scenario. But the second thing is they're not just purchasing treasuries now, they're purchasing the bad paper, the mortgage-backed securities. So that's kind of a troubling development just in of itself. The fact that this is still continuing, but now they're not holding the treasuries, they're holding the mortgage-backs. So I just want to lay that out. These are numbers from their website. It's still happening. These are just official numbers. So even though they don't tell you that quantitative easing is going on, it's for all intents and purposes, it's still occurring.
Okay, great. You want to switch to the next one then, which
Sure.
is the one on the Fed juice?
Sure. So this is chart B. Okay, so I talked about this before, and the market had been going along in a very orderly fashion. You can see the blue chart, the blue line below is what I would call the Fed juice. This is a combination of the data that we receive from the Federal Reserve. It has nothing to do with the market, dealing with purchases, sales, expirations, lending, all of these things that contribute to the market. And the market was basically following this in a very orderly fashion, but things started to change. If you look on the right hand side in 2016, when the market started falling, the Fed had basically turned off their juice or turned off their inflows into the market, and they had to really spike the market to get the market to respond after that January drop. So we can go over to chart C now. And
Oh, sure. Just 1 second here. I'm going to
Sure.
get it right up here. Okay.
And I just wanted to show everybody that, looking at that chart, that blue line has nothing to do with the market. If you can just watch what the Federal Reserve is doing, and you can predict what the market's doing, because they're basically controlling this market. And it's more subtle over longer terms. But what we saw in the Brexit, which I'll get to in the next one, is it was very dramatic. So this chart C here just shows you that as the Fed ended the QE3, the market started to stall and then deteriorate. And so this is a direct result of the Fed dialing down their juice. They still kept it going, as I showed you, but they're having a harder time keeping this going. So this is the market now developing a resistance to the Federal Reserve. And that's a very important thing. So let's go to the chart D now.
Okay.
Chart D is a striking chart, because this is the actual ticks of the Fed juice. Okay, this is what they're flowing into the market. And if you look over on the left, you can see those were the quantitative easing 3 peaks. In other words, we would expect that to be high during quantitative easing. But during the recent declines, the Fed has had to pour more and more and more money into the market to keep this thing afloat. And if you look at that last spike all the way on the right-hand side, that is what they did after the Brexit. So that rally that you saw after the Brexit had nothing to do with natural market forces, had nothing to do with funds coming in and buying. This was 100% the Federal Reserve manipulating the market. I have never in my life seen such a short-term manipulation of the market. Now, we knew that here at Wolf Trader. I told my subscribers that. I said, listen, I said, when the Brexit went down, I said, this thing's going to rally back up. But what I didn't know was the extent to which the Fed would have to exert themselves to make this market come back up. So to me, this is a watershed moment, because this is the first time since 2009 that the market is now developing a resistance and starting to move against the Fed. So we have the Fed purchasing mortgage-backed securities at a rate almost equal to quantitative easing. We have these inflows into the market. surpassing any quantitative easing period, QE3, it's past QE3, and the market, it's not working now. Now the market's starting to roll over. So what I see going forward here is if this trend continues, the markets are going to have a lot of problems because the Fed is the only thing that's been keeping this market up. And, people need to understand my perspective here. I know people don't look at these numbers, but I track and look at the Fed every day. From my perspective, if this continues, the market will rapidly decline and we could have a catastrophic scenario here very shortly, because if the Fed is not able to float this market anymore, nothing will. Okay, nothing will. So this is a very, very, very important moment in the markets right now, because we have to basically see if this resistance will continue. And this is the first time it's ever happened. And the Brexit was different than all the other declines because that was an external event. It was not Fed induced. In other words, this was the opposite. The Fed was actually pumping money in while it was falling.
Mm-hmm. This is really a watershed type moment then, isn't it?
Absolutely. And I think everybody needs to take notice now, because I think everybody in their gut feels that something's been wrong in terms of all of these rallies. How does the market just turn on the dime like that and do this V-bottom? I have the data here to show you why it's happening. I knew that happened. That's not my. I know what the Fed does. That's not my concern. My concern is now the market is starting to resist the Fed, and if they've already passed quantitative easing peaks and the market can barely hold up, we have a very, very big problem on our hands here.
Mm-hmm. Especially if they're buying poor quality paper. This is another thing that you mentioned. This could be really important, because that means that they're really trying to prop something up.
Absolutely. And
sure.
just last week they purchased $19 billion, in mortgage-backed securities. That's on a pace more than $1 trillion a year. So you have to ask yourself, if everything's fine, why are they doing this? And
yeah.
I looked back on during the AIG crisis. Okay, the Fed lends money every day to the banks, and they typically lend between in a normal market between $1 to $3 billion. During the AIG crisis, they lent $25 billion in a day. Okay, how much do you think they lent last Friday, Larry?
We got 30 seconds to go, but okay. Tell me how much.
Okay. They lent $29 billion last Friday. So wow. You're telling me that in the Washington Mutual, they lent $18 billion. So you're telling me that during the AIG crisis, they lent 26 billion. Washington Mutual, they lent 18 billion. But last Friday, they lent 29 billion. Something's wrong.
This is true.
I think we need to pay attention to this, because we need to follow what the Fed is doing. This is a very, very important development.
Okay. We got to take a break here, my friend. Stay tuned. We're going to take my favorite subject matter, the speed of the planets, when we get back.
Okay.
Today, many commodities are trading at relative lows. And now you can take advantage with Everbank's new limited-time, 5-year, market-safe currency comeback CD. This indexed and U.S. dollar-denominated CD offers 100% principal protection and is based on the equally rated performance of currencies of Australia, Canada, Chile, Mexico, and South Africa. These 5 countries are especially rich in commodities, and their respective currencies are poised to do well should commodity prices begin to recover. Keep in mind that no APY, or periodic rate of interest, is paid on the CD. Don't miss out on this innovative new financial opportunity. CDs must be opened and funded by the upcoming July 14th deadline. To apply online and learn more about the CD, including product terms and disclosures, visit everbank.com/TFNN now. This advertisement is sponsored content. Everbank is a member FDIC.
It's 2016, and TFNN has a brand new programming lineup to kick things off. Starting January 4th, Swim Lessons by Thinkorswim and TD Ameritrade will be airing 5 days a week at noon Eastern Time. Join hosts Scott Connor, Kevin Hinks, and Cindy Faber as they host their daily options program live at noon 5 days a week with no commercials for the entire hour. Nico DeHaan and Paige Clark will be moving their program, Living a Primal Lifestyle, to twice a week, Tuesdays and Thursdays from 7 a.m. until 8 a.m. Eastern Time. Wake up with Nico and Paige and start your day off right. The Bull Bear Binary Option Hour by Nadex will now be live Mondays and Fridays at 10 a.m. Start and end the week with the three hosts, Tom O'Brien, Tommy O'Brien, and Daryl Martin, as they break down the world of trading binary options and spreads. For all the details on the new 2016 programming lineup, visit the front page of TFNN.com. TFNN, educating investors. Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Catch the Money Masters as they teach you the art of mastering money when it comes to trading and investing. Next on TFNN.
Okay, we're back, folks, and we're talking with Shane Smolian from wolftrader.net. We're looking at the 1998 Planetary Index. Do you want to fire away with that?
Sure, and I just want to tell everybody too that I've got this whole Fed thing timed down. I can tell you exactly what happens. If you watch the market at about 10:30, that's when they go to auction. That's when they start pushing the money in. So watch the market every day to right around 10:30. You'll see that it usually bottoms right around 10:30, and depending on the volume that they put in, that'll determine the rally of the day. So always watch 10:30. Be very cautious about shorting around 10:30. That's just want to throw that out there to your listeners. Okay, Planetary Speed Index. This is 1998. Now, the one thing I want to point out is that this has been a very good indicator in terms of predicting crash events. And now that we have a Federal Reserve environment that is conducive to a decline, we need to start looking at the astrology now, because now we know that the Fed is weakening. So you see there's a peak here on the left-hand side of the screen, but on the right side, there's this right shoulder that you see. It's a lower peak. And that tends to be where the crashes occur. I don't know why it occurs like that. I mean, sometimes it'll actually happen on the peak, like 2008 happened on the peak. But you can see on this graph in 1998 that it wasn't until it was already headed lower that that next peak showed the decline.
Wow. Now, you want me to go to the next one?
Sure. Let's go to the chart F here.
Okay. 2011.
2011. So this was the summer decline. This was the first real decline that I was able to forecast using astrology. It followed the cycles perfectly. The Fed was taking a break from the quantitative easing. They had just ended a quantitative easing. We were between quantitative easing periods, so the astrology was working well. But look again here. You see this right shoulder here? This is where the biggest decline started to occur. So we had that late July, August decline, and the Planetary Speed Index picked this up beautifully.
Okay, now we'll go on to 2014.
Sure. So 2014, this was not necessarily a crash per se, but it's still following the same line of thought, the same logic here, that after we get that first peak, the second peak is where we would see that decline. And you can see that occurred, and the market did go on to decline into this declining Planetary Speed Index.
Okay, boy, the next one, this is going to blow the folks' socks off, because this really sets up something interesting, doesn't it? This is the situation where we are now.
Yes, so on chart H here, I put an arrow at the top that says we are here. So we're basically sitting at the top of the dome right now. We're at the top of the market in terms of the Planetary Speed Index. In other words, this is the peak for the year. Now, the right shoulder, that right shoulder occurs in right around the 1st of August, somewhere around there. So we're approaching that very dangerous period for a crash. Now that combined with what's happening with the Federal Reserve now, I think that's a big problem. And I think people are going to be caught off guard by the potential size of this decline in the market. It's very difficult to give you price projections people ask me that all the time, like, what is your price projection? Well, I don't know, because the Fed could come in tomorrow and start purchasing the hell out of this market, and I don't know what their limit is. I mean, they're going exponential now, but I can tell you this, that if the trend continues, this is going to be a problem. And we have this Saturn-Neptune energy that I talk about this in the newsletter. So those of people that want to subscribe can read about this. This is the cardinal energy of loss, okay, in astrology. So Saturn is Earth and things that are firm and structures, and Neptune is things dissolving things. So when you put that together, you get like an environment of quicksand. Okay, so you're trying to walk on the Earth, but the ground beneath you that you thought was stable is no longer stable. So this has been affecting a lot of things. It affected the chart of Orlando with the terrorist attack in the nightclub, and we're starting to see it now with the Brexit, because what was the Brexit? It was a dissolving of a boundary. Okay, that's what it was. And so in 1989, when the Berlin Wall came down, they had Saturn conjunct Neptune, because again, what were we doing? We were dissolving a wall. So sometimes it's positive, sometimes it's negative. But in this particular context, I think it's more of a negative tone. And this energy continues all the way into November. Now, in the newsletter, I talk about the specific dates that the midpoint of this will hit coming up. But this is in effect until November, and it also corresponds with the planetary speed index. So, putting these two things together and then putting the Fed issue in there, I think we have a big problem on our hands here going into the elections in terms of the market.
And the next chart we have is the one of our favorites, which is the Bradley model, and it seems to be telling the same story.
Yeah, I like the Bradley. The Bradley is, as you know, and you talk about it all the time, and you use it in your shows. It's one of the oldest barometers. It's a beautiful indicator, and it worked very well before the Fed started manipulating in 2009. But now that the Fed is, like I said, the Fed is weakening, I really like the fact that this is in alignment with the planetary speed index, and they have nothing to do with each other. This is the planet. These are the planets making aspects or transits to each other, or the aspects that they make. And this planetary speed is just how fast they're moving. So the fact that both of these agree, I think that this really, really sets the stage now for a broad-based decline in equities.
Mm-hmm. Shane, most people, well, not most people, but everyone has been, relying on the Fed here since 2009 with quantitative easing, and it's just a giant experiment, and we really are in you mentioned quicksand. I think that's a really good analogy, because, anything could happen here with this experiment, and the fact that we've got $10 trillion in bonds that have negative interest rates now. This could be a real black swan event as you're posing this information here this morning. Absolutely,
and I think the negative interest rate is a problem, and the problem is people don't know where to put their money. That's people are like, well, where do I put it? So at least the bonds are safe, or the treasuries are safe. It's interesting how the Fed talks. They talk one way all the time, like, oh, we're going to raise rates, we're going to do this, we're going to, in reality, look at what they're doing. I mean, they're doing the opposite of that. They're doing quantitative easing behind the scenes. When I hear Janet Yellen speak in front of Congress, it's incomprehensible what she's saying. It's just gibberish. Like, I don't even understand what she's saying. And I saw Alan Greenspan recently come on CNBC, and he said, this is the worst environment I've ever seen. He said it's worse than 2008. This was right after the Brexit, and I think he knows what's going on, because he's like, what are you guys doing over there? And he's seeing the amount of money that they're pouring in, and I think he basically he showed his hand of concern. He was like, this is terrible. Like, what is going on right now?
Yeah, Volcker won't even talk about it. We've got a caller from New York. Richard, are you there?
Yes, gentlemen, could you please speak about who controls the Fed, who makes the decisions? I mean, is the Democrats more probable to keep the market up for the fall elections for Hillary, or do they look at some other venue for making their decisions?
Well, in theory, they're supposed to be looking at the data, but in practice, I would think anyone that's a monetary policy person, such as Yellen or Bernanke, is probably more Democratic leaning, even though they're supposed to be apolitical. So I would think they're trying to keep this market up into the election, but I think they're going to have a hard time doing it. And I will say this. I mean, I think what they did was appropriate in 2009. I think Bernanke literally saved the world in terms of what he did with the initial purchases. But I think we're at a point now that it's kind of like they don't know what to do. Like they're just putting more and more and more money in, and now it's just like, well, what do we do? Like we're going exponential and it's barely holding up. And if you just looked at the market, you wouldn't think there's a problem by looking at it, but behind the scenes you can see this.
Hey, stay with us here, and we'll be right back after these few words. Thanks for calling in, Richard. We appreciate it.
Okay.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back with Shane Smolian of WolfTrader.net, and we've had a question from one of our listeners, Shane, about where will you put your money here, given the fact that you see some pretty negative things coming between now and October. What would be your suggestion?
Well, I think obviously U.S. Treasuries are safe. I mean, even if you have a banking situation and you have FDIC issues, you can always go down and get your money with U.S. Treasuries. So if you want to be ultra safe, I think you need to be. I know it sounds crazy, but that's the first thing I would say in terms of Treasuries being safe. The second thing is, we continue to trade. We trade every day, long and short on the market. So we're just taking selective trades as they come. I would think, you could look for nice short setups on the market. The problem is on the S&P and the E-mini futures, the Fed makes it so difficult. I mean, you see these bottoms. I talked about this before. You have these V bottoms that are forming now since 2009. And we used to get these double bottoms, right? Or double or the heads and shoulder type bottoms. And now the market makes these incredible V bottoms. In other words, it's going down and then it just turns on the dime because the Fed comes in and destroys the shorts. So, I would say, go ahead.
We got a caller from
Sure.
one of our favorite people from Boston. Jay, are you there?
Yeah, hi there, Larry and Shane. Quick question: metals. Do you think precious metals might escape the carnage that you foresee?
Okay, Larry can probably comment on this better than I can because I don't watch metals, but I just think that things are very unpredictable right now in terms of, what's going to happen with the dollar. If you look at with the pound, that's affecting, silver. So, this is going to create a very unpredictable environment when we get this decline, and because it's coming from this hidden factor of the Fed. So, Larry, you want to comment on that in terms of metals?
Yeah, when you have uncertainty, that's when gold does its best. We saw this, in 2011. We saw it in 1980, and we might be seeing it now because we're having these really continuation moves. So I agree with you, Jay, that that's where I'm watching closely. Anytime you get a really nice ABCD correction in gold, buy it. Shane, thanks for coming on, my friend.
Thanks, Larry.
We really appreciate having you on.
Okay, have a great one.
Okay, thank you.
Thanks, guys.
Thanks, folks.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.